Hey, welcome back everyone to day 116 of our live challenge. As Warren Buffett famously said, do not see what is left after spending, instead, spend what is left after saving. Today, we will dive into two popular saving and investment options in India: recurring deposit, which is popularly known as RDs, and systematic investment plan, which is popularly known as SIPs. But which one is right for you? Let's break down the key differences to help you make an informed decision. Let's imagine you are at the bank and considering an RD. An RD, short form for recurring deposit, is like a special saving account. You tell the bank a fixed amount you want to invest every month, for example, say rupees 5,000, and a specific period, say 2 years. It's like a commitment you make to yourself and the bank. In return, the bank promises you a fixed rate of interest on the total amount you deposit by the end of the period. So you know exactly how much money you will have at the end. No surprises. On the other hand, SIP stands for Systematic Investment Plan. Here you are investing in a mutual fund scheme. Imagine a basket filled with different investment like stocks and bonds. A mutual fund scheme is like the basket, which is managed by professionals. With SIP, you invest a fixed amount regularly like RD. So it can be monthly, it can be quarterly. Into this, you can invest this into the mutual fund scheme. Instead of getting a fixed interest rates, you are buying units of mutual fund. The number of units you get depends on the price of the unit on that day. Since the price of the mutual fund units keeps changing based on how the stock market performs, the value of your investment can go up or down over period. Let's talk about the returns. With RDs, you get a fixed interest rate that is typically determined by the bank and the deposit period. So you know exactly what kind of return to expect. For example, if the bank is offering a 6% interest rate on 2-year RD, you will receive 6% interest on your total deposit at the end of 2 years. That's a guaranteed return, no matter what happens in the market. Now, SIPs are a different story. Since you are investing in mutual funds, your returns are not guaranteed. The value of your investment depends on how the underlying stocks and bonds in the mutual fund scheme perform. If the stock market goes up, the value of your SIP investment can potentially go up too. This means you could earn higher returns as compared to RD. However, the stock market can also go down and that could lead to losses on your SIP investment. So, when it comes to returns, RDs offer predictability and safety, while SIPs offer the potential for higher growth but also come with some risk. Now, see, RDs offer a safety net. Your principal amount is guaranteed by the bank and you earn a fixed interest rate. It's predictable option, perfect for those who are prioritizing security over high returns. However, interest rates on RDs may not always keep pace with inflation, especially over the long periods. Whereas SIPs, on the other hand, involve market risk. You are investing in mutual funds where the value of your investment fluctuates with the stock market. This translates to the potential for higher returns as compared to RDs, but also the possibility of losses. RDs come with limited flexibility. Early withdrawals typically incur penalties. So, if you think you might need the money before the maturity period, an RD might not be ideal. SIPs offer more freedom. You can stop or pause your SIP anytime without penalty. However, existing however, exiting a mutual fund scheme before your investment horizon could lead to lower returns due to the power of compounding. So let's get into the taxation, considering for both RDs and SIPs. When it comes to RDs, it's important to note that the interest earned uh, exceeding rupees 10,000 per year is subject to TDS. This means that a portion of your earnings is withheld by the bank before you receive your interest payment. Now let's talk about systematic investment plans. from the taxation point of view. So while dividends from equity SIPs are subject to dividend distribution tax, there is a silver lining. Invest in a mutual fund plan and hold your investments for over a year, and you benefit from long term capital gain tax. This tax rate can be significantly lower compared to other forms of income, especially for investors in the higher tax bracket. So, when considering taxation, investing in mutual funds through SIPs can offer tax advantages, particularly if you are holding your investments for the long term. It's a key factor to consider when deciding between RDs and SIPs for your investment strategies. RDs are relatively less liquid. You can't withdraw your money before the maturity period without without penalties, whereas SIPs offer greater liquidity. You can redeem anytime, but the redemption value depends on the market prices. So, when considering investment options, it is crucial to align them with your financial goals and time horizon. RDs are ideal for short term goals spanning 1 to 5 years, especially when priorities lie in a guaranteed return and principal safety. These are well for endeavors such as emergency funds or saving up for short term goals, whereas systematic investment plans are tailored for long term objectives, extending beyond 5 years. Here, the focus shifts to harnessing the power of compounding and potentially higher returns. SIPs are particularly advantageous for retirement planning or for saving for your child's education, where long term growth is important. Inflation poses a significant threat to the purchasing power of your money. While RD's interest rates offer a fixed return, they may not always keep pace with inflation, particularly over extended periods. On the other hand, equity based systematic investment plans have the potential to outperform inflation in the long run. By investing in equity mutual funds through SIPs, you stand a better chance of preserving the value of your money and achieving real growth over time. It is important to understand the fee structures which is associated with both RDs and SIPs. With RDs, typically there are no charges associated with opening or maintaining an account. It's a straightforward process where you deposit a fixed amount regularly. On the other hand, SIPs may involve some charges. There could be minimal account opening charges, and you will also need to consider the expense ratios charged by the mutual fund company. These expenses can vary from one fund to another and are deducted from the fund's assets, which impacts your overall returns. So while RDs may seem cost effective upfront, it is essential to weigh potential returns against the fees which are associated with SIPs to make an informed decision based on your financial goals and preferences. So, both RDs and SIPs have their own advantages and disadvantages. The best choice for you depends on your specific financial goals, risk tolerance, and investment horizon. Remember, there is no one size fit for all answers. Consider your financial situation and investment goals before choosing between RDs and SIPs. You can even consider a combination of both to create a well diversified portfolio. Happy investing! See